So over the past month, BigBear.ai shareholders have watched the stock fall pretty sharply. And the market is closed today. And we closed the market session yesterday at, what does it appear? Yeah, at $3.54. But then we rose 1 cent in the after hour session. And it's currently trading at $3.55. So naturally, people are going to be having questions such as what's going on with the stock? Did the company lose any of its major contracts? Did management lower their forward guidance? And potentially, they're asking if the previous quarter was a disappointment or just something. There's lots of questions that people are going to be asking. And I want to point out that that's not necessarily the case, and everything at the moment is still relatively the same. But one factor is that investors, even though it's not a big headline, but it's something that I've heard talked about, is involving that Big Bear AI was removed from certain FTSE Russell indexes during the annual reconstitution. So today, I want to explain what that means, how it is that index removals can affect the stock, and why it may create short-term selling pressure, and most importantly, that I want to cover is why there's a difference between the stock price and the underlying business, which is what we talk about all the time on this channel. So again, my name's David here at InvestQ. Feel free to hit the like and subscribe button. But first off, let's understand what the Russell indexes actually are. So the Russell indexes are a collection of companies grouped together based on things like market cap and other index rules. So there's many ETFs, mutual funds, and institutional investors that track these indexes. And instead of choosing stocks individually one by one, they simply buy whatever companies are included in the index, and that's what make index changes important. So I want you to imagine and just put in your brain. Imagine you're managing a fund whose job it is to track the Russell index, and then you see Big Bear AI being removed from that index. You generally need to adjust your holdings so they continue to match the index. So that would mean that funds tracking the index may sell their shares around the reconstitution date, not necessarily because they think the business is bad, but because they're following the index methodology. And this kind of selling can increase supply in the market, and it can put pressure on the stock price itself, which is why we've probably gone down all the way, not a crazy amount. Again, it's a slight dip from $3.78 to now again at the price of $3.55. So nothing crazy, but we still have been seeing some selling activity over the past week. And what I want you to do is I want you to make a distinction and understand the distinction between underlying business and the company. Underlying business and the underlying business of the company and just the stock share price alone. Because quick reminder before we continue, if you're enjoying the content and want to connect with the community, check out the first link below for the free InvestQ community. And if you want access to advanced stock research and tools, the second link is a prophecy 7-day trial for just $7. And last, if you want daily market updates and behind the scenes content, follow me on Instagram using the third link in the description. Now, let's get back to the video. A stock price reflects buying and selling activity that happens every day. The company itself is still executing when it comes to the financial side of their business and everything regarding the underlying business. But the company, so if Big Bear AI, but you have to also understand that if the underlying business, if Big Bear AI itself wins a Pentagon contract, that contract doesn't disappear just because an ETF sold shares. So you have to understand that even though there has been some selling pressure, that doesn't take away from anything regarding the underlying business. So other things to consider is that if the company still has its backlog, its their customers are still growing, if the technology is continuing to improve and its forward guidance has not been changed in a decline in a manner where it looks like things would be declining and they have to pull back, those things don't automatically change just because of an index rebalancing. Now, there is obviously some downside to it. Don't get me wrong. In some of the downside associated with being removed from an ETF like this would be it can reduce demand from certain passive funds, and it also may reduce visibility among some of the institutional investors. And it also can contribute to greater volatility if there's less passive ownership supporting the stock. And those are real considerations that investors should understand. Now, at the same time, some investors see those events as creating opportunities, and their argument is that if selling is driven primarily by the mechanics of the index rather than deteriorating business fundamentals, the market could temporarily price the stock before what they believe it is actually worth. So, whether it is true that BigBear.ai's case is whether the case for BigBear.ai is something every investor has to evaluate on their own. You got to make the decision and do the due diligence on your own. And you got to be looking and making sure you look at the underlying business with the things we talk about consistently, especially for this company with their record backlog, their forward guidance, their growing revenue, improving margins, increasing getting more contracts, expanding internationally, and all the other positive catalysts we have seen for the company. And the fact that they also have real market usage with the products they give out, as we know from a long time, with the services for the facial scanners in the airport. So, what it is I'm going to be watching for me, and again, not financial advice, do your own due diligence. I'm less interested in whether the ETF or had to rebalance their portfolio. I don't really care about that too much. I'm more interested in the questions that I'm assuming you already know what type of questions I'm going to be asking, such as can BigBear.ai continue to grow its revenue? Can it continue to improve margins? Can they convert more of that backlog into actual revenue? And can they win additional defense and AI contracts? Those are the things that will likely matter much more over the long run than one index reconstitution. So, to be clear, absolutely, BigBear.ai's removal from certain Russell indexes may have created additional selling pressure and volatility in the short term. But it doesn't automatically tell us what the business itself has improved or deteriorated. That's why I think investors need to separate what the stock is doing from what the company is building over the coming years. So, as always, these are just my opinions based on my research, and I'd love to hear yours. So, what is it that you think about BigBear.ai? Let me know in the comments below. And if you do like my content, feel free to hit the like and subscribe button. But with that being said, guys, stay safe, keep making good decisions with your long-term portfolios. Happy 4th of July, and I'll see you on the next video.